First Republic shares plunging off just about 15% following its latest earnings release. Now the bank detailing that deposits were down nearly 41% in the first 3 months of the year. That's down from the prior quarter. Here to break it all down, we want to bring in Jason Benowitz. He's CI Roosevelt Associate Partner and Senior Portfolio Manager. Jason, it's good to see you here. So certainly the street taking issue with the fact that we did see deposits drop 40% quarter over quarter. What's your first take at these results?
Yes, so you highlighted what I think is the most important takeaway from the results, which is that First Republic deposits declined. We were all expecting a decline, of course, but it was more than we expected. So, sort of a baseline expectation headed into this quarter was perhaps that, there was a report on March 19th that First Republic had lost $40 billion in deposits, but then, $70 billion. But we also know that they received $30 billion from the consortium of 11 banks and sort of a private sector rescue. And so the net of that, we would have thought that the deposits would not have fallen by the $100 billion that was reported today.
Okay, so from their CFO, Neil Holland, we moved swiftly and leveraged our high-quality loan and securities portfolios to secure additional liquidity, adding we are working to restructure our balance sheet and reduce our expenses and short-term borrowings. How would you characterize their health, and what do they need to do moving forward?
Right. So because they lost so much in deposits, they have to replace that funding somehow. And so they're doing it with borrowing. But the problem is that deposits are a low-cost source of funding, whereas borrowing is a higher cost, and it really is going to weigh on their profitability, both in the reported quarter as well as going forward. So this isn't really a strength of theirs. Now, what they're talking about is, they have to fix that somehow. They have to find, new deposits to somehow sort of lower their total cost of funding and repay some of those borrowings. But, I continue to wonder how they're going to be able to do that. So this is another concern that sort of flows from the fact that the deposit outflow is worse than expected.
Jason, how hard is it to get a full picture on the stability of this bank right now? Because the company also withdrew all of its prior guidance. They're not taking any questions on the earnings call. So how do you look at that from an investor perspective?
I mean, I'm not really surprised that they're not giving guidance because things are so uncertain. I really wouldn't have expected them to. So that's not really necessarily a disappointment. But what you highlight is, the stock continues to be very volatile. And the reason is that the future of this company is very uncertain. So, there's some potential that they can sort of right the ship and, shrink to the point where they are sort of profitable on the business that they've retained. And then there's some value, perhaps even greater than book value going forward, if you assume that kind of rebound. But on the other hand, it's going to be very difficult for them to do that because their cost of funding is so high. They're no longer an investment grade bank, which is a real challenge in this industry. And so, they continue to, at the same time that they are operating the bank, they're looking at their strategic alternatives and who might they be able to partner with and sort of get a rescue from. And all of this is ongoing. There's many different ways it can go. And that's why, as investors sort of change what they think the probability is of these different scenarios, the stock moves so violently as perhaps we're seeing after hours today.
Jason, the Fed whisperer, as we call him, Nick Tamiros, writes in the Wall Street Journal over the weekend why the banking crisis isn't over yet. He's citing the former Dallas Fed president, Robert Kaplan. How do you think this banking crisis will continue to play out in the quarters ahead?
So we do think that there's been some stabilization sort of from the worst throes of this crisis earlier in March. And so you can see that, for example, if you measure, there's something called the forward rate agreement overnight index swap spread, and that will tell you it's a measure of bank funding costs that includes credit costs, and it peaked, in early March, and it's come down to sort of its 10-year average, actually, so that seems very reasonable. Similarly, we look at the Fed's balance sheet disclosures weekly, and they disclose how much crisis borrowing there is by banks, and that number peaked about a month ago, and it's been coming down weekly ever since. So these are signs that things have stabilized. I think what perhaps Tim Reyes and Kaplan were referring to is the next phase of the crisis could have to do with commercial real estate. And we know that banks lend to commercial real estate. They're an important source of funding for that market. And so if we were to see sort of banks pull back, it's not clear who would step up, and there could be defaults. And so and there have begun to be some already. For example, Brookfield, the real estate investor, has defaulted on some loans. And so this is an area where, perhaps it could, again, make investors nervous and reignite the crisis. But so far, things have stabilized from where they were in early March, and there's no this is more of a long-term thing that could play out over quarters rather than something that's imminent.
Yeah, Jason, talk a little bit more just about those broader implications, just in terms of what we're seeing play out in commercial real estate. I guess, how bad could it potentially get?
Right. So, commercial real estate, obviously, it's a major market. And What's unique about it is that these regional banks are typically the ones that fund it more so than other markets, and so they have a meaningful presence there. And then the bank crisis, what it's done is it's taken these these regional banks and it's said to them, your funding costs are going to be higher in the future. There's likely to be more regulation coming down the road, and it's likely to sort of have them kind of rein in their activity broadly, but it will be most impactful in this sector. And then you can layer on top of that, if you just think about within commercial real estate, the office market, where vacancies are lower because of remote work trends. There's been a lot of construction in recent years. That's sort of vulnerable anyway. And all those things, these are the areas where the banks that are most exposed to those could be most impacted. Now, that's not First Republic. So in essence, First Republic shouldn't be so shaken by this type of activity unless other banks were to become wobbly, and then it might spill over in sort of a chain reaction.
All right, we'll keep our eye on that. Jason Benowitz, appreciate you coming on, sir. Thank you.